Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis on Monday, August 24, 2015. Whoa, what a day today. Well, so I guess the correction is here, right? It's here to stay, so that much we can agree on. I've taken all the stuff off the chart that was here from before because we no longer need it. Now we're focused on where the next levels are that we can find support. And interestingly enough, I worked on this all weekend long, and I almost put out a video during the weekend to show you what my findings were, and I decided not to because the levels I had were what I thought were good, but however, keeping in mind that it was a very high likely scenario that the foreign markets, meaning China and the other Asian markets, and then Europe overnight would open up hard down, which they did, and which would cause our market to also open up hard down Sunday night, which it did. And I figured, you know what, I'm not going to try and A, pick a bottom, and B, give everybody a false sense of security that a level that I'm providing over the weekend would be good and cause you to make a bad trade. So instead, I left it alone, and hopefully everybody stayed safe, and we'll go from there. And let's see what I found. So here's the likely scenario. Let's just get right into what I think is the likely scenario. First, we have to go back to what happened intraday today, okay? Because the action today looked like the market was oversold. Everybody realized it, and then we were going to bounce higher. We just got to a ridiculous number, almost like the flash crash in 2010, and then the market would recover and life would go on. And we actually were positive on the NASDAQ, or at least the Qs were positive today, and the Dow was down a very small amount in comparison to what it was down at the open, which was over 1,000 points, and the S&P, same routine. So what happened was we made that low, and then we rallied up and failed. And the reason why I believe we failed was because the rally happened right out of the chute. And what I mean by that is when you rally right out of the chute in the morning off of a low like that, where the Dow's down over 1,000 points, the S&P was down at 182, I think it was, 182.95 at the close, which was like 16 points from Friday's open, or 17 points lower than Friday's close. Pardon me, not open but closed. And then we rallied in the morning. That's not a good sign, because what you want to see, and you've heard me say this a number of times, it's not how they trade them, it's how they close them. And for the market to recover and hold that recovery all day long after the third hour today, in my mind, was an unlikely scenario. And if you remember on Friday, I told you if I see a market reversal, I'll let you know. And I almost sent out an email today, and my better half, meaning whichever side of the brain was my smarter side, told me don't do it. It's too early in the day, and if it doesn't hold, I'm going to put a lot of people in a bad situation. So I didn't do it, and I'm glad I didn't, because, and here's the rub, because based on today's close, I think we're going lower yet. And let me go back and let's talk about this. Okay, so let me just move this over. And then I'm going to show you something that is eerily similar in my mind, okay? And the markets don't necessarily repeat themselves over and over again, but a lot of times they do look the same. I guess the old adage is they don't necessarily, history doesn't repeat itself, but it rhymes. Well, the market is the same thing. Okay, the reason why history repeats itself is because history is based on human behavior in large part. And the market is based on human behavior. So there's no difference in things that happen, whether it's world events, whether it's politics, whether it's business, whether it's the market. It's all driven by human behavior. And human behavior is also ever present in the market. So human behavior takes over. And that being said, I think, in fact, let me bring it up now. Look at 2010. I just took a little snippet of the chart from the flash crash of 2010 that I wanted to show you. So here it is. Here's that one day where the market had a flash crash where the Dow was down 1,000 points in like 30 minutes. Okay, and then we rallied back up, and then we failed and made lower lows, and then we tried to rally again and failed again and made a final low. Okay, in I think it was July of 2010. And then finally the market started to recover. And then I even think it went lower after that. I know it went lower than that in 2011, but it recovered most of that loss, okay, over the coming months. Now, the reason I'm showing you this is because now look at where we are today. Okay, here's that same, let's call it the flash crash. It's not a flash crash, but it's a crash, okay? Here's the same thing, okay? Now, whether or not we rally up a little bit for a couple of days, okay, like this, okay, and then roll over, or we just, that's possible, or we just continue lower, okay, make a new low. Let's say we make a new low. Let's do this. Let's say we make a new low tomorrow or Wednesday or both down here, okay? Then I think we do rally, okay, for a week or two, or somewhere in that neighborhood, and then I think we roll over once again. Okay, so either way, okay, one way or the other, and we'll know it when we see it, okay, we're either going to make new lows relatively close by, meaning almost immediate, or we're going to fake everybody out and rally up to work off some of this oversold condition, maybe make a 382 retrace or a 50% retrace. And just let me just show you what that would look like. Okay, and what I'm going to do is I'm going to take it from the last pivot high, okay, which was just the other day, I think on the 18th or 19th of August. Okay, and if this was the low today, okay, then here would be a 382 retrace, here would be a 25% retrace, and here would be a 50% retrace. But we can't really say that that's a possibility up until the point in which we do see a low. Now, I can't call this a low today because we have to see how tomorrow trades out. But my indication is that we haven't seen the low based on the fact that we didn't close well today. It tried, okay, we tried to make a 50% or even 618 retrace. We came up short of the 618 retrace, okay, so it was in between a 50% and 618 retrace from low to high today. In fact, I'll show it to you. Okay, from low, okay, to high today, you can see that we came up short of the 618 retrace, so it was in between. Now, that's not necessarily that meaningful, but I'm just going by how the market closed today, and I didn't like the close. In fact, I think that this close today, the fact that we failed, spells lower prices coming sooner than later. All right, so let's go over to the longer time frame and let me show you what kind of numbers I'm looking at. Okay, now I had this line in here this weekend, and as you can see, it was relatively decent, but it certainly cut through it like a hot knife through butter again this morning, and then rallied back up and closed just almost on that line, slightly above that line. This line is at 187.19. We closed at 189.50 today, or at least that's where we finished out the aftermarket, or we're trading in the aftermarket session now. No, this was the close. So, you know, I don't think it's a good low. So I'm looking for lower prices, not necessarily all the way down here just yet. So don't look, this is a weekly chart, right? So I'm not looking for this tomorrow, although anything goes at this point. And the reason why I can't give you a solid number right now is because we're really in the midst of a market crash. So for me to call a low before it happens is a fool's game. Okay, I'm going to be right probably 1 or 2 out of 10 times, and I'm not going to do that to you. We have to see the market put in a meaningful low, something to trade against. Okay, and then once we have something to trade against, meaning we know where we're wrong, then we can take some long positions. But right now, like for example, think about it like this. Traditionally, every 1 point in the E-mini contract, okay, right now is really like 5 points. That's how fast it's trading. All right, so we're seeing a little bit of a rebound in the aftermarket session now. Who knows what we see tomorrow morning? I just want you to stay safe. And that being said, I want everybody to stay safe. And that being said, I'm putting this video, and I just want to give all the members notice, I'm putting this video out for the public to see on YouTube tonight because I just want everybody to understand, whether they take what I say with a grain of salt or as meaningful information or not is up to them. But I want as many people to see this as possible because I want everybody to stay safe. And I want everybody to understand that you folks as members knew, not that you knew a crash was coming, but you knew that the market was not going higher. That much we knew. We knew that the maximum upside we were going to see was 212, and then we were going to see a sell-off. We just saw the sell-off before the 212. But either way, any way you look at it, and remember this, okay? And this is for everybody out there. Remember this, okay? We had a line in here that looked like this, okay? Yeah, it looked like this. And we had another line that looked like this, okay? Whoops. We had another line that looked like this on the top side, all right? And we knew that we were running out of time. And I was telling you that time is up once this pinches together, okay? And time was up before that pinched together. So basically the bottom line is that any way you look at it, time was running out, and all the folks that were with me for a long time knew the market was going to sell off. It was just a matter of how much and where we would find a low. So that's where we are now. We're looking for a low, and we're not going to try and pick the bottom. We're going to let the market tell us where the low is, and then we'll have something to trade against where we know where we're wrong. And that's the most important thing from this point forward. Okay? So from that point, I guess, well, oh, you know what? There's a couple other things I want to show you that are meaningful. Okay? So let's look at the weekly chart here. Take a picture of this in your mind, okay, and see where we are. This is the October 2014 low. We came up just short of that today, okay? This number, sorry about that, folks. You know how the video affects the charts. But we came up just short of that today. This low was at 181.92, and the low today was at 182.40, okay? That's this is the weekly chart, but that's where the low was today. Now, look at the Dow, all right? Let me switch over, and you can see where the Dow whistled through that low from October 2014 and is heading towards, came up just short of the 200 period moving average. The markets will have a tendency to catch up with one another, okay? So, as you can see, the Dow is now, all of a sudden, the weak index, where it wasn't before. It wasn't the leading index, now it is, okay? Let's look at the transports, okay? The transports cut through the 7,700, which was this low here, like a hot knife through butter, and this is the weak index, okay? So now, this is not showing any signs of strength, so there's lower prices coming in the transports. So you can see, I'm looking at all the markets. Here's the NDX, which is the NASDAQ. The NASDAQ has not hit the October 2014 low. That's coming, okay? These are some of the reasons why I'm looking at all different kinds of markets, all different kinds of analysis. I'm looking at Fibonacci retracements on a daily, on a weekly, on a monthly basis. I'm looking at all the markets. I'm doing all the work necessary to cut it down and give you at least the Cliff Note version of what my findings are. And my findings tell us that we haven't seen the low yet. I don't want you to be fooled into thinking today was the low. Maybe it was. But if it was, we'll know it over the next couple of days, and then we'll have something to trade against. But I'm like 90% sure that there are lower prices coming, lower than the low today. It's just a matter of whether that happens immediate or it happens after a rally for a week or so. That's the only question mark in my mind right now today. Okay, so I'm positive that lower prices are coming. I just don't know whether they're coming right away or shortly after a slight rally. And I don't want you to be fooled into this market. Don't listen to the pundits. Don't listen to the so-called experts on TV. They're wrong 90% of the time, as you know. Okay, I've proven that to you time and time again. Okay, I've got a handle on what's going on here. I've ridden this rodeo before. Okay, I've seen this before. I've read the script. I know how the movie ends. Okay, the likelihood of today being a low, a meaningful low, a sustainable low, is very, very slim. You can take that to the bank. Okay, all right. Let's move on and go over to the gold market and see what we have there. Let's go flip over to the daily chart. All right. All we're doing now is, and I told you Friday that this was going to be pretty good resistance up in this area here. Okay. And as it turned out, sorry about the squiggly line, but as it turned out, that was good resistance. Okay. We saw that happening. And now all we're seeing is a pullback inside of a bullish pattern. Okay. This is a bullish pattern. We're going to see probably another few days of a pullback, and then I expect higher prices coming. And whether those higher prices come immediate or they come once the market finds a low and then rallies up for a few days, and we need to see a rally for several days and then turn back down. And at that turn back down of the stock market is when I think we'll see the higher prices in the gold market. But I'll keep telling you each and every day what I'm seeing, and the higher prices coming are going to start to go towards $11.95 to $1200 in that neighborhood in the price of gold. It's just a matter of whether we see it now or in a couple of weeks or sometime in that neighborhood. Now, how do we know whether that's going to be sooner than later? If we start to close daily above this level here, which is what is it? 60. It's 1169.80. So if we start to see daily closes above 1170, then you can be rest assured that we're probably going to see a relatively quick move up to the 1195, 1200 neighborhood. And there certainly could be higher prices after that, but that's the first target, the first area of resistance, and it's also going to coincide with around the 200 period moving average, and you can expect to pierce through that level. So got a pretty good handle on this one too. Just my preference is that we see another few days of sideways to down move off of this high that we saw the other day last week, and then I would suspect we're going to see higher prices coming in gold. Okay, let's go over to the oil market. Okay, and the oil market, again, there's nothing to see here, right? There's absolutely nothing going on that we want to know about oil other than it's melting away, continues with lower prices until and unless we see a daily market reversal, a daily reversal candle, something that takes out, for example, this candle here and puts in a high volume reversal day. That will be the first sign that we're seeing nothing other than a short-term bounce in the price of crude oil. Okay, there's just nothing to see here. There's nothing to do. Don't be trying to pick a bottom in crude oil. It's just not there yet. It will be there. It's just not there yet. If I come up with some numbers, I'll give them to you. But right now, I have to believe that we're heading towards the low from a few years ago, which I believe was about $32, give or take. So there's nothing to see in the oil market. Let's move on. The bond market. Okay, so we saw a spike higher in the bond market. We made the 162 area. Okay, I'm going to show you the TLT in a minute, but I just wanted to show you the price of bonds because this is where I had the 162. Okay, we made the 162 today, even higher. We had a high today of 163.1, which is a huge number. I mean, you're talking about making all-time highs in the bond market, and this is where I was telling you, in fact, let's flip over. I'm going to flip around on you a little bit. Let's flip over to the 30-year yield. Okay, and you can see I had some lines in here for you. This gap window and then this gap fill. and we took those out today. And you can see how I was telling you that we're going to start heading towards the lows that we saw from several years ago in the bond market. In fact, the low here was from only March of 2015. But if you pull back the curtain on the monthly number, okay, and we're already, look at this, we're already from 2008, we're already at those numbers from 2008, and we're going to challenge the lows, if not close to it, from January and February of March 2015. This is the 30-year bond yield, okay, and this is the 10-year bond yield, okay? So as you can see, there's nothing going on that's good news for an interest rate rise. And now everybody on the financial media is talking about the fact that there's no way the Fed could raise rates in September based on what's going on. Well, where did you hear that first? You didn't hear it on TV first. You heard it, I don't know where you heard it first, but you certainly heard it here for a long time, right? I didn't just say it for the first time last week. I've been telling you that the bond market is telling us there's no rate hike coming. Even though we're only talking about a quarter point, it's all about human nature. It's all about psychology, and it's all about what the Fed is able to do. And right now, if the Fed raises rates, you can rest assured that the market won't like it, and the market will let the Fed know. But I would suspect that the Fed has no interest in raising rates, and no interest being no pun intended, no interest in raising rates anytime soon. Okay, the market is the dog. The market is the tail, and the Fed is the dog, and the market wags the dog, or the tail wags the dog, the market wags the Fed. There's just no two ways about it. It is what it is. So let's look at TLT before we move away from the bond market, and let's go back to the daily chart. And as you can see, based on the daily chart, okay, this was my high-end target was 127.25, cut through that like a hot knife through butter, and then finished on the lows today, or close to the lows, not on the lows. But this is a good reversal candle, so there's a high likelihood that the bond market's going to spend a few days pulling back here. But that doesn't mean that we're going to break this uptrend until we see, numbers like down here, okay? I don't like that number here. Let me show you what I'm talking about. This uptrend won't be broken until we break below this number here. So all this was, right? I told you this, consolidation, higher prices coming. Here are the higher prices. And now there's a likelihood that we'll do this, okay? And then we'll do another up move coming, okay? So the bond market still remains in a bullish position, okay, until proven otherwise. And it will be proven otherwise when we break this low here, okay? So that's my take on the bond market, okay? So this is another area where you've been watching me tell you higher prices in bonds coming, lower yields incoming, no interest rate hike coming, and that's what the bond market's been telling us for a long, long time, okay? The dollar got smoked again, and we're going to start looking for a tradable low in the dollar, looking for higher prices coming over the longer term, okay? I'm looking now, and once I have some kind of a tradable low on a longer term basis, okay, it's really in this area here, okay? We almost got there today. But if we hit 92 and we can see a reversal off 92, then we're going to start looking for a tradable low in the dollar, looking for a long-term, let me show you why, a long-term low. I'm going to go way to the monthly chart. Now watch this. You see this? This was the breakout line that I showed you months ago. Okay, and the folks that have been around for a long time remember this. I showed you this breakout and I said, if we come back to test this line, or at least get close to it, that's going to be a sign that we're going to see higher prices after we retested this line. Now, we don't have to retest this line because, see this big green up candle? Okay, this is going to provide a really, really solid level of support. Okay, so on a monthly basis, we may pierce through this, okay, but I'm expecting, and this is 1, 2, 3, 4, 5, 6. We've been moving sideways to lower for 6 months in the bond market. I'm sorry, the dollar. Okay, so once I see a tradable low, okay, what this is telling us, this is the same as the bond market. It's the same chart. This is an up move, consolidation, readying for another up move, higher prices coming in the dollar. It's just taking these monthly charts take months and months and months, sometimes years to play out, okay? So you have to be aware that as opposed to a daily chart, okay, this looks totally, totally different, okay? This is that line from that breakout point, and that's why I left it in there. We're looking for a tradable low, looking for a long-term rally in the dollar coming later, okay? All right, let's move on to natural gas. Natural gas, daily chart. We're comfortably below, oh, this isn't the natural gas chart. This is the natural gas chart. This is the October contract. Now we're comfortable below my channel, and I don't like it. And I'm going to show you why I don't like it, meaning for long trade. I think lower prices are coming in natural gas. Let me show you why. Okay? Forget these lines here. What is this telling us? What is this move telling us? Okay, long sideways consolidation, down move, long sideways consolidation, down move coming. Okay? Whether it comes this month or next month, I don't know exactly yet. Yet is the operative word. But what I can tell you is that this is the same pattern as this, okay? Which is also the same pattern found in other markets, okay? Can we find one like that in oil? Okay? This is the long-term monthly chart on the continuous contract in oil, crude oil, right? Down move, long sideways consolidation, another down move. Okay, this is the monthly chart. Okay, you can see sometimes we get skewed with the daily chart, and you're going to have rallies along the way. And on a daily chart, okay, if I go back to the daily chart, well, let me go back to the daily chart of the natural gas market. Okay, on the daily chart, all right, there's nothing that says that we can't rally back into this channel and fail, or we could just go sideways for a few days or even a few weeks. You know, we don't know yet, and once I have a better picture, I'll let you know. I'm going to let you know each and every day. But if you don't trade natural gas, it doesn't matter. You can take the lesson from the chart patterns that I point out, okay, and the fact that when we break below important levels, that becomes bearish. This will become resistance, what was once support. It doesn't matter what chart I'm showing you. What matters is the chart patterns and how I put the pieces to the puzzle together. That's what makes all the difference in the world. Okay, so, you know, when I look at a daily chart and show you a daily chart, don't forget, I'm also looking at a weekly chart. Okay, and what's this showing me? On a weekly basis, this is showing me that until and unless sorry about that, folks, until and unless the natural gas market can close above 2.963 on a weekly chart close, there's nothing going on here except what? Lower prices. Okay? That's it. Okay? Unless we can close above this area. And if we do, which is really coinciding with the top end of the channel, until we do, there's nothing bullish about this on a longer term basis. Can we get in this channel on a daily basis and trade it back and forth like we've been doing? Absolutely, sure. Okay, but I'm just showing you the bigger picture because I want you to see the bigger picture on all markets, because this is the time you need to see and experience the bigger picture, because everything has changed, okay? We've entered into a bear market in the stock market, okay? Whether you want to believe it or not, whether other folks want to believe it or not, they want to tell you there's buying opportunities, and there are buying opportunities. There will be buying opportunities. All I'm telling you is that we have to see whether I'm right In fact, whether it's lower prices first or we rally for a week, 10 days, and then lower prices after that. And until we can determine that, okay, we don't have anything to trade against yet, and you're better off being safe than losing money. And that's just the way it is. I'm here to keep you safe. I'm here to make you money, but I'm also here to keep you safe. Now's the time when we need to let the market tell us what its intentions are, and then we can certainly have something to trade against, and we'll go from there. Okay? With that, tonight, I'm going to leave it there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis, and please be safe. Keep your money in your pocket. If you're nervous about the markets, if you don't have something to trade against, then don't trade it. Have a great evening, folks.